Okay, so you may have hit your trigger rate, or you're wondering what the heck a trigger rate actually is and how it works. Well, we're going to talk about that and why it's in the news so often these days, and why the news is making something bigger than it really is. But it is an important consideration, and we always want to understand specifically what you can do when you come across a mortgage situation that is concerning for most families. So today, let's dig into what's a trigger rate, what are your options, and what you can do going forward. Well, we've seen all the news highlights for the better part of the last year, and it sometimes can look really scary. Things around 60, 70, 80, 90-year amortization periods to pay off a mortgage for a lot of families is their worst nightmare. I'm here to tell you today that a trigger point isn't such a bad thing. You just need to understand specifically how it works, what it means, and how to take action around your trigger rate. I'm Alex McFadden here, a mortgage broker and wealth expert with Flow Mortgage Co. And today we're gonna dig deep into this trigger rate topic. But before we do, make sure to go ahead and hit that like and that subscribe button so you can get the best financial information when it comes to your real estate and mortgage portfolio going forward. So what exactly is a trigger rate first and foremost? Now, a trigger rate is the point at which you're no longer paying off any of the principal on your mortgage. Now, as you can recall, most conventional mortgages are made up of a monthly payment. And in that monthly payment, you're typically paying both principal and interest. Paying off the principal is what typically reduces the mortgage balance on your loan. Now, you can obviously make monthly payments, and some mortgages allow for things like lump sums and increases to payments. But the trigger rate itself is the point where your standard monthly payment is no longer paying off any interest. So what do you do? Because for a lot of people, that's scary, and they don't like the idea of paying an interest-only monthly payment. Now, let's start off here. What does a trigger rate actually apply to? Well, it doesn't actually apply to all mortgages. It only actually applies to specific mortgages in Canada that have a fixed payment. And these mortgages are typically a variable rate. So there are two different types of variable rate mortgages in the country. One is an adjustable rate mortgage and one is a variable rate mortgage. An adjustable rate mortgage is actually a mortgage where the payment will increase or decrease dependent on what happens with the Bank of Canada. Now, when the Bank of Canada increases or decreases their overnight rate, as you know, this will impact your prime lending rate. The other type of loan is called the VRM, or variable rate mortgage, or otherwise known as a fixed payment or frozen payment variable rate mortgage. And in many circumstances, a lot of families love to have this type of loan because it creates cost certainty. You know exactly what you're paying every single month, and you don't have to think about fluctuations in the marketplace. And it's only actually been recently where there's been circumstances where anyone has had to think or be concerned about having this type of loan because the Bank of Canada increased interest rates so quickly. Now, what's happening is we are seeing Canadian mortgages get to the point where they are no longer covering the principal and they are now paying interest only on their mortgage payments. For a lot of families, it's less concerning because they are aware that in many circumstances, the interest rates from the Bank of Canada will eventually decline, putting them back into a position where they'll be paying principal and interest, or they have a thought process to do lump sum payments. More on that later. But for many families, this is surprising and scary, especially when the news overhypes things and puts news articles out about 60, 70, 80-year amortizations. So again, what does this look like for you? If you have a frozen payment, fixed payment, variable rate mortgage, ultimately, what are your options and what can you do? Now, the first option is that you can do something called increasing your monthly payment. Now, many mortgages allow people to increase their monthly payments by 10, 15, 20%, and sometimes as much as double. Now, what this will allow you to do is to do a few things. Number one, if you increase your monthly payment yourself, you can choose to increase it to the point that you're just paying off the interest. You can increase it to the point where you're paying interest plus a portion of principal, or you can increase it to the point where you're paying down back to your original amortization period. This creates a lot of flexibility around continuing to keep your mortgage as it is right now, as opposed to switching to, say, a fixed rate mortgage where the payments will be set and determined by that fixed rate mortgage. Now, again, what actually happens if you hit your trigger rate? So we discussed it briefly there where we talked about your options to increase your payments. That's one of the options. The other options that you have available to you are to pay a lump sum. Now, you can essentially, with most loans, pay a lump sum mortgage amount, some annually, some monthly, some on any regular scheduled payment, and you can pay a lump sum to essentially just pay off any of the unpaid interest on your loan. So for example, if you missed out on $5,000 of unpaid principal or interest, you could actually do a lump sum payment with your existing mortgage company by reaching out to them and asking them to withdraw that money from your account. Now, most lenders don't make it out such that it has to be $5,000. In some situations, it can be as little as $100 and whatever you can contribute, but that's an option that you can take to put your mortgage back on track. Other options that you can take are locking in your mortgage or refinancing to a different fixed rate term. So let's start with locking in your mortgage because a lot of people are considering doing that. Now, if you're planning to lock in your mortgage, your lender will only allow you to lock into the remaining term left on your loan in most circumstances. What that means is if you have 4 years remaining on your current mortgage, they'll typically offer you a lock-in mortgage for 4 years remaining at whatever interest rate that they have available. Now, the challenges associated with that are that you will go to the same amortization period. So if you have 29 years or 21 years remaining, and you're going to automatically see an increase to your monthly payment as it will put you back on track with your amortization schedule, but with a new higher interest rate. Now, for some people, that's great because it provides them cost certainty and certainty that they're actually going to pay off the mortgage over a set period of time. And for others, that can be a little bit scary because ultimately you want to control your destiny. And if interest rates are to come back down in the next 2 or 3 years, you could be in a situation where you're locked in at a higher interest rate payment. What some other people are considering doing is refinancing the mortgage to a different lender or different term at a lower fixed rate and or re-extending the amortization period back to 30 years. Let's touch on the first one. Most of the banks that you're working with, when they offer you a lock-in option, they're not going to be very competitive. They're typically going to offer you a lock-in option, which could be as much as 0.5 to 1% higher than other conventional mortgage options. So you do have the ability at that time to switch out to another lender, restructure your loan, and actually reduce your total interest rate into a locked-in term of a different length or different mortgage altogether. Now, this is something that we are seeing a lot of families consider, and perhaps a lot of people miss out on because they don't know about it, because it is saving thousands of dollars of interest, but providing the cost certainty of locking into a fixed rate term. Another consideration is to do something called a refinance. And a refinance is when you're restructuring the mortgage. It could be extending the amortization period back to 30 years and locking in. You could be taking on more money to pay out the other debts. You could be taking out money for the purposes of backup plan money. We've seen circumstances where clients are going through a rough period of time and they need to take out a little bit of extra money to get them through the next 1 or 2 years while interest rates stay high. All in all, a refinance is something that you could consider doing, especially if you're in a circumstance where you are not certain about your financial future, you need to pay out other high interest debts, or you want to lower your payment but still lock in your existing mortgage term. Now, in the end, trigger rates shouldn't be something to be scared of, but they should be something to be considering. Which one of those options makes the most sense to you could be locking in, increasing your payments, paying a lump sum, or refinancing. It really depends on your personal financial situation. So the question is to ask yourself, A, do you believe interest rates are going to come down? B, are you in a situation where you could afford any other increases or decreases to monthly payments? C, would you rather have cost certainty and pay the associated cost to switch into a locked-in term, even knowing that interest rates could come down? And then D, are you in a situation right now financially where you have any other concerns over other debts, outstanding loans, or need to take out money over the course of the next couple of years? That's a lot to digest. So if you want to dig deeper, make sure to have an independent conversation with someone who can look at your whole financial situation in detail. This way you should be able to complete detailed analysis, understand specifically which is your best option, and then move forward from there. If you found this video helpful, make sure to click that like button, that subscribe button, and we'll see you on the next one.